Ever wondered that the overall optimism for better future performance of stock is high in bull market? And it is only the bull market that paves way to a bear market when stock prices fall and correct themselves. Yes, there are two main cycles, bull cycle and bear cycle. Stock market are subject to bull and bear cycles. A bull market is when buyers are willing to pay higher and higher prices as the overall optimism for better future performance of stock is high. But do you know how does it happens? It happens when businesses are expanding, which are going at an above average rate, which faces favorable and growing demand for their products and services and are able to price them profitably. Or it could just be a change in perception or excessive liquidity in the system. The returns to equity investors goes up as stock prices appreciate to reflect this optimism or perception change. But the bull market can overdo its exuberance. As buyers pay higher and higher prices for stocks, prices move beyond what can be justified by the underlying intrinsic value. Also, businesses tend to overcharge themselves, borrowing to fund expansion based on optimistic forecasts. And also, it increases the input cost for raw material and labor. Interest cost for capital also increases as the bull market reaches its peak. Unrealistic expansion in prices tends to correct itself with a crash. And that's how the bull market paves way to a bear market when stock prices fall and correct themselves. A downturn in economic cycles can lead to stress for several businesses when they face lower demand for their products and services, higher input and labor costs, and their lower ability to raise capital and in many cases risk of survival. When the economic conditions change, several businesses that begin profitably become under stress and begin to fail. Bear market in equity reflects this pessimism. At this point, stock prices falls. Seller quit in despair, accepting a lower price and a loss on their stocks. Now, as a price may fall well below intrinsic values, buyers who find the valuation attractive will start coming into stocks that now are priced reasonably or lower. Now, at this point, central banks come into role. Central bankers reduces the interest rate to give push to consumption and investment, and slowly the bear cycle gives way to the next bull cycle. Hence, a bull market is considered to complement bear market, meaning they are opposite market conditions where one signifies rising prices and other signifies falling prices, essentially representing different phases within the market cycle. When one ends, the other typically begins. Thank you for watching. If this video is informative, then do like, share and subscribe to my channel.